Good evening, sir.
Good evening.
Welcome to all. This special lecture series program for all undergraduate students on finance and its allied areas is organized by Kolkata Bidhannagar Society for Academic Advancement, coordinated by Azure Academic Services. Today's topic of discussion is set off and carry forward of losses. Today, our guest, Professor Sandip Bhattacharyya sir, is with us. He is full-time faculty of THK Jain College, Kolkata, India. Welcome, sir.
Welcome.
Yes, sir. You can start your lecture.
Okay. So thank you, sir. Thank you for this brief introduction. So greetings to everyone. So first and foremost, I would like to thank Kolkata Bidhannagar Society for Academic Advancement for giving me such an opportunity to share my thoughts about our topic of today's discussion. I would also like to thank Azure Academic Services, that is entire organizing committee, for conducting such a wonderful program, especially in finance and its allied areas under for undergraduate students. So I hope that in today's discussion we'll provide some of the valuable insights into the evolving trends and various type of challenges in the field of finance as well as the allied areas, particularly the students pursuing the pan India level for undergraduation program. So we can explore the different opportunity that one of the key areas our focus in today in taxation respect. That is, in taxation, I can say that it will play a very crucial role for shaping our economic policies. It will play the very crucial role for different framing of financing strategies and the overall stability of our economy. So that understanding the various areas, understanding the various concept of taxation, especially those for the undergraduate students, so that it is essential that how the complexity will evolving that taxation may merely affect in the following respect, so that we can say not only the individual taxation, not only the corporate taxation, not only the public finance, everything under our one statutory regulations, and that this concept will be foundational and may ensure the fairness, compliance, as well as the economic growth. So, let me share our thoughts or that my views under the set off and carry forward under the direct taxation area. So, now I am sharing my screen.
Yes, sir. It is visual.
Yes. So, as you can see that our special lecture series is going on, that is a set off and carry forward of losses under the direct taxation. Now, before I move on to my topic, that under the direct taxation, you will see that there are five heads of income. That is income from salary, that is income from house property, that is income from profits and gains from business and profession, income from capital gain, as well as the income from other sources. So that if you clubbing the five heads of income, that is actually your gross total income. And from this gross total income, you may have some deduction. That is deduction, you know very well, my dear students. That is under section 80C to 80U, that is chapter 6A, under the old taxation regime, because there will be two regime. One is old taxation, another one is a new taxation. So that now I am talking about first the old taxation, then I will move on to the new taxation regime. So that under the old taxation regime, so some sort of deduction under section 80C to 80U,
Hello.
it will be deducted from the gross total income. So that after this deduction, you will get the net taxable income, and then you can apply the various taxation rate. That means some of the income under the specified areas of taxation, and the rest will be accounted by the normal slab rate, that is called tax slab rate. Suppose I am talking about winning from lottery, I am talking about the long term capital gain, I am talking about the short term capital gain under shares, and the long term capital gain from security, stocks, bond, etc. So some of the income, it will be taxed under the specified taxation rate, and the rest of the income, that is salary, rest of the income, that is house property, and the various type of other sources of income, it will be under the specified taxation rate, that is the under the normal slab rate. But my question is that if I am having income from salary, that means in salary there will be no negative income. But in case of house property, there may possibility of negative income. In case of profits and gains from business and profession, that is income from business, it may incur losses. That means income from salary, it cannot be incurred any losses, that is negative income. But in case of house property, it will be incur losses. In case of profits from business, maybe there will be negative profit, that is losses. In
Hello.
case of income from capital, yes sir.
Yes, sir. I think your PPT is stuck in the second slide. Are you changing the?
Yes. I am just giving the brief introduction,
Okay.
then I will move on this slide.
Okay, sir. Okay. Thank you.
Okay. Thank you,
Intro.
thank you. So in case of house property, there will be losses. That is, if I am having self-occupied house, that means I have paid some interest on loan. As you know very well, my dear students, that interest on loan. In case of self-occupied house property, self-occupied means, that means the residential house property for the owner. So there may be some loss. So how can you adjust the losses? Because you have to pay tax on your income. But if I am incurring some losses, is it be negligible? No, my dear students. As per the Income Tax Act 1961, there will be a provision that you can set off your losses. How we can set off, then we will move to our next slides and the going on. But this is just a brief introduction to you before I start this chapter, or that before I start this topic under the today's discussion scenario, so that so that there will be provision, there will be some rules that you can set off your losses. But how, that will be shared in my slide. So that setup means, that means you can adjust your losses with your respective income. And carry forward means you may not adjust some losses. So in a next and next two consecutive year, it will be carry forward, but there will be some restriction. What are they? Then we will see in the later on. So for the introduction, my dear students, that is setup means, that means you have to nullify your losses with your income. You have to nullify your losses against your different respective income. And carry forward means you may have different losses, you may have income, but sometimes you may incur losses but you do not have any income. So that how can you nullify it? So you can simply carry forward to the next assessment year and going on as per schedule permitted by Income Tax Act. So now I am sharing, that is set off, just I have mentioned. So set off means, that is adjustment of losses of the eligible profits of the year. So that we can say, just we have mentioned, suppose you are having income from house property, that is from the let out house property. Let out means there will be a tenant and landlord relationship. That means there will be a interconnectedness in between tenant and landlord, so that there will be some rent received in the hands of an owner, so that this is the income. But you may have more than one house, and one house is strictly for your residential purpose, and for this purpose you are required to pay interest on loan, because when you build up the house there will be some loan adjustments, and then the EMI is still going on, and that EMI you are have to pay, that is principal and interest. So that this interest on loan you are required to pay, so that we can say that your self-occupied house property may incomes or losses. And if you are having more than house property, that is more than one house property, that you are having some income, so that this loss can be adjusted with the income from house property, so that it refers the adjustment of losses against the eligible profits of the year. And it will be governed, see my next point, that it will be governed under section 70 and 71. Now what is 70, 71? Don't worry my dear students, I will clear it. So that under the Income Tax Act, this loss or the set off or the carry forward will be governed by under section 70 and 71, because you know very well that under section 70 and 71 only deals with this kind of adjustment of losses. Now, as you can see in my next slide, that is set off is divided in two parts. One is intra-head adjustment, another one is inter-head adjustment. As I mentioned here, that already you are supposed to know, that is intra-head means same head of income against the same head of losses, or you can say that same heads of losses chargeable against the same heads of income, that is governed under section 70. If I am telling you that I am incurring losses from capital gain, that means I am in a position of capital loss. But simultaneously, if I sell one particular securities or house or bonds, that I am incurring some gain. So this capital gain loss can be adjusted with the capital gain. So that means this is the within the same head of income, that is under section 70. That in previous slide I told you that it will be governed under section 70 and 71. So that under section 70 it is intra-head losses. That means same heads of losses chargeable against same heads of income. Now coming to the inter-head, that is the other side, that is inter-head adjustments. So that means if you are having some losses from house property and you are only having one house, that is for your residential, so what you can do, you can charge these losses with the other heads of income. For example, suppose there are 5 heads of income: salary, house property, profits and gains, capital gain, and the other sources. Suppose I am having some house property losses, so I can adjust these losses with the other scenario, that is the other heads of income. If I do not possess any sort of income or that any other income from house property, so that section is under section 71. So my dear students, that according to under section 70, it is inter-head, that means that is same heads of income, that is intra-head losses. And under section 71, that is inter-head adjustment, that means with the other heads of income. Now, as you can see, just I have mentioned that I have already written, that is 70 means, that means setting of the losses one sources against income from the other source within a same head. That is just I have already mentioned here, loss from one self-occupied house property can be set off against income from let out property. Just I have mentioned. That is, if you are having self-occupied house property and you are paying interest on housing loan on self-occupied house property, you can adjust these losses with your let out house property. Loss from any textile business can be set off against profit from leather business. Now you can ask me a question, sir, why you have mentioned the name of the business? There are some sort of other business. Now, the answer is, my dear students, that is, there are two kinds of business, namely, that is a speculative, another one is the non-speculative. Now, whether I am talking about textile business, leather business, grocery business, any sort of business, it will be termed under the non-speculative business. And under the non-speculative business, what will be the taxation difference? The taxation difference is non-speculative business, that is, whether I am incurring profit or loss, it will be taxed under the normal taxation slab rate. But if I am talking about some speculation business, that is intra-trade trading of securities, that is one of the biggest example under the speculative business, it will be taxation under the specified tax rate, that is 15% and 20%, that will be the relevant percentage. So that any sort of non-speculative business loss, first we are trying to adjust the same thing, that is the same business or the different non-speculative business from the profit area. Now if we move to one sort of example, these are very simple and these are very clear wise, that is the example, that is income from house one, it is 4,50,000. It is a very simple example just for your understanding, my dear students. That is loss from house 2, it is 3,25,000. So now you can see that if you are supposed to compute the total income under the house property, that is income from house 1 is 4,50,000 minus income from house 2, it is 3,25,000, that is 1,25,000. Similarly, if you are having a profit from business A, that is 5 lakh. If you are having the loss from business B, that is 2 lakh. So that if I am asking you, that is what is your total income, or that what is the taxable income from business, you can say that taxable income from business, it will be profit from business A minus loss from business B. It is a very simple, loud and clear. That is 5 lakh minus 2 lakh, that is 3 lakh. So that this will be a very simple example under the same heads of losses, that is under section 70. So that what we are trying to understand, that is under section 70, that is intra-head adjustments. Now if I move to some rule, that is rule of inter-sources adjustment. Now what is inter-sources adjustment? As you can see, my rule number 1 that I have mentioned, loss from speculative business can be set off only against the profit from speculative business. Now I have already mentioned there are two types of business. One is the speculation, another one is the non-speculation. Non-speculation means these are normal day-to-day trading business, that is the working capital total turnover business, that is grocery, that is leather, that is various type of textile, and the any other sort of business that is not specified under the income tax act. So that if I am talking about the speculative business, suppose one of the example just I have mentioned, that is stock market, or that is the intraday trading, or that other type of speculative business that is mentioned under the specified taxation regime, that is loss from speculation business, it can not be adjusted, that is profit from non-speculation business. Please do keep in mind, my dear students, this is very very important. You can see loss from speculation business, that means you are incurring some losses. My dear students, please do see it very very carefully. You are incurring some losses, that is loss from speculation business. So it will be not supposed to adjust profit from non-speculation business. That's why I have mentioned it cross. So that means if you are having profit from leather business, and if you are having loss from speculation business, that the two business under the income from PGBP, that is profits and gains from business and profession, and that you can set off it, it will be totally wrong. So the loss from speculation, it cannot be adjust that profit from non-speculation business. So that what is the remedy? You can see the next one, that is loss from non-speculation business can be adjusted with profit from speculation. But now it is totally the controversy area. It is totally the diplomatic area. That means loss from speculation which cannot be adjust profit from non-speculation. This is very simple. But loss from non-speculation, that means I am incurring some losses from the textile area. That means from the textile business. And but it can be adjusted with the profit from speculation business. So that this is number one. Next, number two, that means just I have mentioned here, that is loss from non-speculation business can be set off against the profit of non-speculation business and the speculation business. So that if you are incurring some loss from non-speculation, so that it can be set off from the non-speculation business of profit and also the speculation business of profit. So, but for the setting of the speculation business losses, you need to necessarily have income from speculation business. That means if you are having loss from speculation business, you may have that profit from speculation business. Otherwise, it will be carried forward. Next is rule number two. So that I hope rule number one is clear to all of you. So that next is rule number two. Rule number two is loss from weighing and activity maintaining of resource can only be set off against income from same basis. Now, sir, what does it mean? It means that if you are having some income or losses, that owing and maintaining of resource, that it can be adjusted with the same heads of income, not in a other space of income. I repeat this once again. I repeat, my dear students, that is, if you are having a losses, that is owing and maintaining of resource, you can adjust it with if you are having an income from owing and maintaining of resource. Otherwise, it cannot be nullified. Otherwise, it cannot be nullified with the same accounting year. That means in a same assessment year, better you can say. That means you know very well there will be a previous year, there will be an assessment year. Previous year means that means you are incoming, that means you are incurring some income or losses, and that assessment year, that income or losses will be accountable or taxable in a one particular year, that is called assessment year. That means in an assessment year you have to file your return, you have to pay taxes under the various income tax filing area. So that this is the, so that is the rule number two, that is the loss from activity owing and maintaining of resources can only be adjusted with the same heads of income, that is profits from owing and maintaining of resources. Now I am moving to rule number three. No loss can be set off against winning from lotteries or horse race or the various type of specified business area. Now, if I am incurring some losses regarding winning from lottery, that means, so that means I can adjust it only and when I am supposed to winning from lottery in a one particular previous year. That means if I am incurring some losses of different horse race activity, so that I can adjust it with a one particular financial year, that is the profit from different horse race activity. If it is not possible for the same year, that means that is the other sort of financial year. So that this is rule number three. And rule number four is very, very crucial. Sir, why? Because long-term capital loss can only be set off with long-term capital gain. My dear students, please do it underline very, very carefully. I am repeating, long-term capital loss can only be set off against long-term capital gain. Now your question may be, sir, how can you classify long-term and short-term? So that in case of long term, if you are holding some securities that is other than the fixed asset, that may share, stock, bond, debenture, equity share, preference share, different types of securities. If the holding period is greater than 12 months, please do repeat it. If the holding period is greater than 12 months, it will be termed as a long term asset to some extent. But in case of fixed asset, that is other than securities, if the holding period is more than 24 months, it will be termed as a long term capital asset. That means one is security, another one is other than security. In case of security, it will be 12 months. In case of other than security, it will be 24 months. Now the long term capital loss, may be income from the securities only. The long term capital loss may be income from the other than securities only, so that it can be set off against the long term capital gain, so that the long term loss can only be adjusted with the long term capital gain. So why I uttering this so many times, because it is very very crucial when we are doing some in our next to next slide. That means you can see that there will be number of losses, so that and also there will be number of income. So that how can you classify that the it will be adjust or that it will be carried forward? So that if you are go through the rule very very carefully, that you can see that there are some provision, there are some regulations with this adjustment of losses, so that long term capital loss cannot be set up. You can see long term capital loss cannot be set up against against the short term capital gain. So that if you are having short term capital gain, then the long term capital loss cannot be set up, so that the long term capital loss can be set up against the long term capital gain. If you are not having the long term capital gain, if you are having against the short term capital gain, it will be not being set up with the same particular financial year. Next, that is just a synopsis that what is long term and short term capital loss. So that as you can see, however, for the purpose of setup of short term capital loss, both the short term capital gain and the long term capital gains are available. It may not be clear from the sentence. Now you can classify it. If you are having long term capital loss from this statement, that is however statement, it may not be clear, but it will be clear in my next to next. That is, if you are having long term capital loss, it cannot be set of short term capital gain, it will be crossed. But if you are having short term capital, again this controversy area, just I have mentioned the controversy or the diplomatic area in a speculative and non-speculative business. Please do remember it in my previous slides. So same thing is here. If you are having long term capital loss, it will be not being adjusted with the short term capital gain. But if you are having short term capital loss, it can be adjusted with the long term capital gain. So this is the main thing. The short term capital loss, now you can say, now you can read the statement. However, the purpose of short term capital loss, I think now it will be clear. However, the purpose of short term capital loss set off in both the cases, either the short term and long term. So that if you are incurring short term capital loss, you first try to adjust it with short term capital gain. Now, if you are not having short term capital gain, then you can see that whether the long term capital gain or not. If there is a long term capital gain, you can easily set off the short term capital losses. But the reverse is not true. That is, the reverse may not be done. There is long term capital loss that cannot be adjusted with the short term capital gain. Only the long term capital loss, it will be adjusted to the long term capital gain. So that this is the synopsis that what we are supposed to state in this segment. So now rule number 5. So that what is rule number 5? Loss from an exempt source of income cannot be set off profit or from our taxable sources. Sir, what does it mean? That is, you know very well that under section 10 of Income Tax Act, under the direct taxation area, that any sort of exempt income that will be under section 10. Suppose for example I have mentioned here that is the agricultural income. So that this agricultural income, that if you are having some losses from the agricultural income, it cannot be set off, that is profit from other non-speculative business. In this case I have mentioned textile business, that is one of the non-speculative business example. So that if you are having, sir, I am incurring some sort of losses under section 10 subsection 1 subsection 2 3, so that it will be, so that it will be not being adjusted with the current or the specified areas. So that this is the one of the various type of rule under section 70, that is intra head set off. So that just you can see that this is the synopsis, that is loss from let out house property, that is profit of deemed to be let out house property. Now your question is said, you have mentioned that is self occupied house property and the let out house property, so that what will be the deemed to be let out house property? As you know very well, my dear students, that is deemed to be let out means, suppose you are having more than one house, suppose one house, two house, three house, and suppose as per the Income Tax Act you kept for yourself that is maximum two houses. But if you are having more than two houses, so that means the next one will be considered as deemed to be let out, even if there will be a tenant or there will be no interconnectedness in between tenant and landlord. Sir, what does it mean? Please do make it clear. So that this statement actually relies on that means, if you are having more than one house property, suppose I am having three flats in Kolkata region. So that now, as per the Income Tax Act, there will be a provision of two flats I can use my self residence or the own residence, that is called self occupied. But the third one, even if I am using for a self occupied, now as per the Income Tax Act, that if the flat is owner, that means owned of your name, that means the mutation area, so that your flat will be taxed as under the deemed to be let out situation. That means the fair rent of municipal value higher of and the restricted of the standard rent. That is the rule of house property, that is calculation of reasonable expected rent. That means fair rent and the municipal value which may be higher but restricted to standard rent, that is the Rent Control Act activities. So that's a different thing. So that our concern is, that is loss of let out house property can only be adjusted with profit of deemed to be let out house property. Second thing is, loss from speculative business cannot be adjusted profit from leather business, means one of the non-speculative business. Loss from agricultural activities outside India can be adjust income from debenture. Now here the statement is contradictory. Just I have mentioned that loss from agricultural activity cannot be set up, but loss from agricultural activity outside India can be adjusted with income from debenture, bonds, or the different types of fixed type of obligation of securities. This statement is contradictory, so please do underline this statement. That is, loss from agricultural activity outside India, it can be adjusted with income from business. Sorry, income from debenture, that is the bonds, that is the fixed income bearing of securities. So now we are move on to the inter-head adjustment. So far I have concerned that is intra-head adjustment. Then I will move on to the inter-head adjustment under section 71. I hope that up to this it may be clear to all of you that what is set off, what is carry forward, and what is intra-head adjustment. So that now I am moving to my next slide, that is inter-head adjustment under section 71. So under this inter-head adjustment, under this section, as you can see in my slide, If the loss, I am not just uttering that what I have written in my slide, I am just telling you beyond this slide which may not be written in my slide, because as you know very well, my dear students, all these things may not be accompanied with the same slide within a very same statement. So that I have written the very short synopsis. Now I am telling you that is what are the background of this synopsis, or the what are the different backgrounds of thoughts in my mind. That means if you are incurring some losses, just I have mentioned, if you are incoming, or that if you are incurring some losses from income from house property, suppose you may have only one particular house property, so that how can you nullify it? If you are supposed to be a housewife, if you are a housewife of a one particular financial year, and that if you are supposed to have a pension, as well as if you are having the one house property, so that how can you adjust these losses? If you are paying that interest on loan on that house property that is self occupied, and that you are having the one source of income, that is income from other sources, that is pension, that is suppose the family pension, so that how you can adjust with the intra head setup that is under section 70 with the same heads of income? So that there will be a provision, my dear students, that is 71. So that this 71 section actually deals with, that is inter-head adjustment. That means if you are not having the same heads of income, it will be charged under section 71, that is intra-head income. That means the loss can be transferred to the, or the chargeable, that is the other heads of income. So that there will be some certain rules. So that as you can see, a very simple sum. Profit from business is 70,000. Loss from business B 2,90,000, and that income from house property is 5,10,000. Now there is a situation that is profit from business A it is 70,000, loss from business B it is 2,90,000, and the income from house property is 5,10,000. Now your question may be, sir, what is the type of the business A and business B? If there is a non-speculative or speculative, you have to raise this question, right? So sir, if you are written that is the business A and B, and the what are the different types of business, because as you can say that is the, there are two types of business broadly, that is speculative as well as the non-speculative. If you are the, if you are having a speculative loss, so that how you can adjust, that is intra. Yes, my dear students, that is if I am having the speculative loss, I can only adjust with the speculative gain from the business. But if I am having the non-speculative loss, then the first I try and foremost, that is profit from non-speculative. If it is not, then I will move to the other heads of income, that is other than the business income. So that you can say that profit from business A is 70,000, loss from business B is 2,90,000, and the income from house property 5,10,000. So that what will be the total income for an assessee? So that as you can see, profit from business A it is 70,000, and against the loss from business B, rather than it is 2,90,000, but still I am supposed to charge against 70,000, because I am not having an income of 2,90,000. I repeat this once again, that loss from business B 2,90,000, I can only set off under section 70, that is intra head set off only 70,000. Now if I am having the other source of income, that is income from house property, that will be 5,10,000. So from this 5,10,000, this loss from business B, my dear students, please do make it very, very clear. That is loss from business B, that is 2,90,000 minus 70. Why 70? Because 70 has already been adjusted against the business A. So that 2,90,000 minus 70, that is 2,20,000, it will be subtracted from the income from house property, that is 5,10,000 minus 2,20,000, that will be 2,90,000. So that what is your total income? So your total income is, that is 2,90,000, because income from business and the income from house property, if we adjust the losses, we are having the total income of 2,90,000. So I repeat this once again, that is loss from business B is 2,90,000, irrespective of, that is I am having the business income is 70,000. So 70,000, that will be nullify the losses of 70,000, and that again 2,90,000 minus 70, that is 2,20,000. So that these 2,20,000 will be subtracted from the other heads of income that I have mentioned under section 71, that is 5,10,000 minus 2,20,000, that will be 2,90,000. So that what is your total heads of income? That is the income from business and income from house property. If a clubbing of it, so that it will be 2,90,000. I hope it is clear to you. So the next is the rule number 1, that is loss from speculation business cannot be set off of income against the other head. That I have already been mentioned. That is, if you are having the speculation business loss, it cannot be set off, that is any other heads of income. That means speculation loss can be set off with the speculation heads of income. Profits under the gains of business and profession cannot be set off against income from salary. Now, very, very important one. If you are incurring some losses from your business, if you are incurring losses from your profession, it cannot be set off if you are having income on salary. That means if you are having income from salary, it cannot be adjusted. That means income from that means loss from business or the loss from business and profession cannot be adjusted. And the rule number 3, loss from owing and maintaining of resource can be set off against the income from same business. Just I have mentioned. That means if you are incurring some losses from owing and maintaining of horses, it can be adjusted with the profit from owing and maintaining of resources. So that these can be same heads of income, that is under section 70. Right? So that this is the rule 4, that is any loss under the heads of capital gain cannot be set off the any other heads of income. So that whether I am talking about the long-term capital gain, whether I am talking about the short-term capital gain, so the long-term and short-term both under the capital gain or loss can be set off against the capital gain head. No other heads of income can be nullify this type of losses. So the long-term or short-term capital gain cannot be set up with the any other income from other head, and in short, provision under section 71 shall not be available the losses under the heads of the capital gain. That means under section 71 that actually deals with the inter-head losses. That means capital gain loss may not be moved to the other heads of income, so that it can only restrict themselves under section 70 of the capital gain portion. So that now you can see that is long-term capital gain, that the synopsis, that is actually the synopsis, that is loss under the capital gain cannot be set up the any other heads of income, that will be crossed. But a loss under the heads of house property, that can be set off with the long-term and short-term capital gain. That means loss from house property. My dear students, this line is very, very important. Loss from under the capital gain, it cannot be set up, that is the any other heads of income. That means loss from house property, if you are having a house property losses, it can set up the long-term capital gain as well as the short-term capital gain. That is his right or the tick portion. That is, I am repeating this once again, that is loss under the capital gain cannot be set off any other heads of income. That means if you are incurring long-term loss, if you are incurring short-term loss, whether you are having salary, whether you are having house property income, whether you are having business income, whether you are having income from other sources, it cannot be adjusted. But if you are incurring some losses from your business, if you are incurring some losses from the house property, whether I am talking about the interest on loan, whether I am talking about the let out property, that means that loss can be adjusted with the long term or short term capital gain. Next is that no loss can be set off against winning from lottery, crossword puzzles, card games, horse race, betting, etc. That is the casual income. So the just I have mentioned, no loss can be set off against this winning from lottery or the various type of the specified type of income. So that loss from non-speculation business, that is that can be adjust only profit from owing and activity maintaining of resource. That is, if you are having some losses, if you are having some losses from the non-speculation business, it can be adjust. But if you are having some speculation business loss, that is profit from activity owing and maintaining of resource, even if you are incurring profit, it cannot be adjust. And that is UAD. My dear students, UAD means unabsorbed depreciation. What is unabsorbed depreciation? We will see in the later on. That is, unabsorbed depreciation can be adjusted with the long-term capital gain. Now, this is the synopsis. Now, this is the synopsis in a nutshell. That is, house property loss. Same heads of income, house property income, business loss. And now, if it is a house property loss, and then if it is not being adjusted with the same particular year, my dear students, please do listen very, very carefully. If it is a house property loss, if it is not being adjusted with the same particular financial year, so that you can carry forward how many types of year? That is 8 assessment year from the date of incurring of losses. So that I repeat this once again, that is the house property loss, same heads of income. If it is not a same heads of income, you can go through the other heads of income. But if you are not having the other heads of income, it can be carried forward up to 8 relevant assessment year from the date of incurring of losses. Next is the business loss. So the business loss cannot be adjusted with salary. So that business means speculative and non-speculative, that I have mentioned, that is speculation business as well as the non-speculation business. What are the different kinds of regulations? What are the different kinds of provisions? So that this business loss can be carried forward with the next 8 relevant assessment year. Next is the speculation loss. So speculation loss can be adjusted with the speculative income. If it is not the speculative income, or that if you are not having the speculative income with the same respective financial year, then it will be carried forward up to 4 assessment year. Short-term capital loss, that is STCL, short-term capital loss. So the short-term capital loss can be adjusted with the short-term capital gain as well as the long-term capital gain. And that if it is not, then it will be not being allowed to the any other heads of income. Simply it will be carried forward up to the 8 assessment year. Same thing is the long-term capital loss, that is LTCL, that if you are having the long-term capital gain income, then it will be only be adjusted. If it is not the long-term capital gain income, it cannot be set off. That is any other heads of income that will be carried forward for the 8 assessment year. So loss of when on maintaining of race horses, that is the same heads of income, that is income from such activity, and that it will be carried forward up to 4 assessment year. And that is unabsorbed depreciation, my dear students, that I have already mentioned in my previous, that is UAD. As you can remember, UAD, that is the unabsorbed depreciation. It will be allowed to the any heads of income, and there will be no time limit. So the summary of the rules, that means what we have studied. That is, we have studied that before we move on to the sum. That is the income from house property. You can adjust its salary, you can adjust it business income, you can adjust it capital gain, you can adjust it income from other sources. If you are having the loss from speculation business, that is the speculative income only. If you are having loss from non-speculation business, you can adjust it with the house property, you can adjust it with the capital gain, as well as you can adjust it with the income from other sources. Similar thing, if you are having the long-term capital loss, then it will be the long-term capital gain. If you are having short-term capital loss, it will be the long-term capital gain as well as the short-term capital gain. As well as if you are having income from other sources, that is the salary, house property, that is the loss from various type of the other sources, that is salary, house property, business income, as well as the capital gain. So just it is a synopsis. So if I am telling that is carry forward of the losses, that is loss which could not be set up against the income of the assessment year, it will be not being losses or lapse it will be allowed or carry forward with the next relevant year. That means if you are incurring some losses, and that if you are saying, sir, I do not have income with the same head, or the sir, I do not have income with the other heads of income, so that don't worry about it. So that it will be simply carry forward to the next relevant assessment year, but to some extent with the income tax regulations and provisions. Now it is unabsorbed depreciation that I have already mentioned. Unabsorbed depreciation means depreciation can be charged only to the extent to bring the profits to the nil. So that, sir, what does it mean? Suppose if you are having income from business before charging depreciation rupees 70,000. I am repeating it. If you are having income from business and that income from business that is before charging depreciation of rupees 70,000, and now if you are having depreciation of rupees 90,000, how much? That is rupees 90,000. So what is the maximum extent you can charge the depreciation against profit? That is 70,000 if you are having income from business before charging depreciation. If you are having depreciation of rupees 90,000, you can extend to charge against profit rupees 70,000. So what about this 20,000? Because your total income from business is 70,000 before charging of depreciation. I am repeating this once again, repeating it. That is income from business, it is 70,000 before charging depreciation, and that you are having depreciation of the business asset or the business class of asset, that is rupees 90,000. So that you can only charge rupees 70,000 because your income is 70 but your depreciation is 90. So that if you are having irrespective of 70,000, so 90 minus 70, that is 20,000. That is called the unabsorbed depreciation. So that in this case, I have mentioned there, hence, if profit is less than depreciation, that is 70,000 in our example, less than 90,000. So depreciation minus profit, that is rupees 20,000 in our example, that is called unabsorbed depreciation. So that I hope up to this it is clear to all of you. So the treatment of unabsorbed depreciation, just I have mentioned here, that is the unabsorbed depreciation first to set off, that is profit from any business or the profit from business and profession. But if it is not that, it can be set off the other heads of income except salary and casual income. So I repeat this once again, that is unabsorbed depreciation can be adjusted. Because why it is the so much given priority income from business? Because only the thing is that if you are incurring some depreciable assets regarding of your business activity, and this is the running of your business, so that you first need to chart that all the depreciable value under the profits from the business. But if you are not having the profit from the business, so that it can simply be set off to the other heads of income, but there will be some restriction, that is casual income as well as the salary. But if you are having only the business loss and no other income is there, it will be carried forward to the next relevant assessment year, and there will be no time limit. So that this is the order and priority to set off. Now up to this we have done the rules, but how can you set off? First, you are required to set off current year losses. Now listen my word very carefully. Up to this we summarize the rules. That means how can we set up the losses? That means different heads of income, that means the different types of heads, that means the intra head, inter head, whatever it may be. Now it is the time to show that how can you show the losses or the different types of set off. So first you need to priority current year losses. Then you can adjust if there is any residual income, then you can adjust the brought forward losses. So first priority is current year income minus current year losses. If there is any further more residual income or residual income, then if you are having some brought forward losses, it can be adjusted. Suppose, just take an example. Suppose I am having one last year losses. Suppose last year house property loss 20,000. I am just telling one of the very shortest example. I am having one last year losses and that will be 20,000. Now in this current financial year, I am having income from house property as well as the loss of house property. Now, what will be ordered to prioritize? So that the order to prioritize is first you nullify current year losses with the current heads of income. That means loss from house property for current year will subtracted from the profit from or that income from house property of the current year. Now, after deduction or after subtraction of current year loss, if there is any residual income, now from this residual income, you can adjust the last year losses. So that this is the order and prioritize to set up. This will be clear when you are supposed to do 2 or 3 sums in this scenario. So next is the rule of 71B, that is set off and carry forward. Now, if you are having some income, if you are having some losses, so that it will be prioritized with the next one part of the year. Now, this is a very simple, just we have mentioned this sum, that is 70,000, 2,90,000. This is just for your information. So now we are moving to one of the example. Mr. X has the following income and losses for the previous year 2023-24. Income from business A 1,80,000, loss from business B 62,500, income from house property 1 it is 84,200, loss from house property 2 it is 30,000, short term capital gain it is 25,000, and long term capital loss it is 22,382. Compute the gross total income of Mr. X for the assessment year 24-25. These are very simple. So that means we are having income from business A, we are having house property, we are having income from business B, we are having loss from house property 2, we are having short term capital gain and also the long term capital loss. Now this is a case of intrahead and interhead adjustment of losses. This is actually the twin examples, that is intrahead as well as the intrahead adjustment of losses. So that let's see how this sum will be proceeds. So that as you can see, this is the solution. That is computation of gross total income of Mr. X for the assessment year 24-25 relating to previous year 23-24. So that there will be income from house property. So first we need to that the prioritize, that is salary, house property, PGBP, capital gain and the other sources. So salary, there will be no income from salary. House property, yes, there will be income or might be some losses from house property. Then the next order is income from profits and gains from business and profession. There will be no profession, there will be only income from business. Then there will be the capital gain and there will be the other source, there will be no other source of income. So that first, income from house property 1. As per the question, it is 84,200. Just see the question once again. That income from house property 1, it is 84,200. I hope it will be clear to all of you. That is income from house property 1. Then the loss from house property 2, it is 30,000. So just to coincide the solution, that is income from this one. Just I am trying to mention it. That is income from house property 1, that is 84,200. And the loss from house property 2, that is 30,000. So it is a intra-head set off. What is it? It is a intra-head set off. That is same heads of income chargeable against same heads of losses. That is house property loss can be adjusted with the house property income. So that this is called intra-head set of losses under section 70. So that after deduction this 30,000 loss, it will be 54,200. I hope it is clear. That is the first one. Next, as you can see in my question, that is income from business A 1,80,000 and loss from business B, that is 62,500. So now as you can see the solution, that is income from business A, it is 1,80,000, and loss from business B, that is 62,500. So simple. Again, there will be an intra-head setup. No need to worry about that is as section 71, that the whether the inter-head setup. Now the question is third one. Short-term capital gain is there, as well as the long-term capital loss is there. Now there will be the contradictory portion. Short-term capital gain is there, another one is long-term capital loss is there. So short-term capital gain is 25,000. It will be very much clear. But long-term capital loss, how you can adjust, my dear students? You cannot be adjust against the short-term capital gain, because as I have mentioned in the note number 1, as you can see, this is the note number 1. Long-term capital loss can only be set off with long-term capital gain. If not, then it will be carried forward up to 8 assessment year. So, my dear students, this long-term capital loss, what is the loss amount? 22,382. So this long-term capital loss 22,382 will cannot be adjust any other heads of income. That means it will be carry forward. So in our next financial year, if I am having long-term capital gain, first we need to prioritize the long-term capital loss for the next financial year. Then we can adjust with the brought forward of long-term capital loss. So that long-term capital loss cannot be adjusted with the any other heads of income as well as the short-term capital gain. So it will be termed as nil and under the note number 1. So if I am having the total of uh, total gross total income of Mr. X, that income from house property, it will be 54,200. Income from business, it will be 100. Uh, Income from business will be 1,17,500, and income from capital gain will be 25,000. By clubbing of these three heads of income, we will get the gross total income, that is 1,96,700. I hope this is the first type of sum. It is clear to sorry, it is clear to all of you. So next I move on to the next sum, that is something different from the first sum. Mr. Y has the following income and losses for the previous year 23-24. That is, there will be an income from salary, there will be a loss from textile business, that is 2,85,000. There will be a profit from grocery business 1,20,000, and income from house property, it is 85,000. Now this is another type of scenario. So compute the gross total income of Mr. Y for the assessment year 24-25. So that what we are having only salary income is 3,60,000, loss from textile business is 2,85,000, profit from grocery business is 1,20,000, and house property income is 85,000. So let's see. So this is the computation of gross total income of Mr. Y for the assessment year 24-25 relating to previous year 23-24. So first is income from salary, and I told you that in salary you are not incurring the losses. In salary you are not supposed to incur any sort of losses if you are employment to some particular extent, so that you are having income from salary, that is the emoluments, that is 3,60,000. But the case number 2, that is income from grocery business, it is 1,20,000. But how much loss will be? Again I am sharing some once again, that is loss from textile business, it is 2,85,000. Just you can say I am highlighting this portion. Loss from textile business, it is 2,85,000. And profit from grocery business, it is 1,20,000. Only this highlighting portion 1,20,000. So now, as you can see, as per the rule, that is income from grocery business and loss from textile business, it can set off with the same heads of adjustment. What is the section? Under section 70, that is intra head adjustments. That means grocery business income can be nullify the losses which will be the textile business 1,20,000. So we can say that the total textile business loss is 2,85,000. So we can only adjust 1,20,000. But what is the rest? So rest we are trying to adjust the next heads of income. I repeat this once again, just you can see. Loss from textile business. I am sharing the sum slide once again. Loss from textile business is 2,85,000. And profit from grocery business is 1,20,000. Both are the non-speculative of business income. So that we can only adjust 1,20,000 losses. So that how much remaining? 2,85,000 minus 1,20,000. That is how much? 2,85,000 minus 1,20,000. That is 1,65,000. So 1,65,000, to some extent we are not supposed to adjust any sort of losses. Now, coming to the case number 3, that is income from house property, that is 85,000. And loss from textile business, maybe there will be some spelling mistake, that is it is textile business, not the tactile business. It is a textile business. Now, okay, so that is the loss from textile business, that is 1,65,000. We are having the residual losses, but under the income from house property, that is 85,000, we are only supposed to adjust only rupees 85,000. I repeat this portion once again. Grocery business income is 1,20,000. Textile business loss is 2,85,000 as per our scenario. So that grocery business income 1,20,000 minus loss from textile from 2,85,000, we can adjust with the 1,20,000. So that what is the remaining? 2,85,000 minus 1,20,000, because 1,20,000 has already been adjusted. So that 2,85,000 minus 1,20,000, it is 1,65,000. Now, this 1,65,000 will be move on to the next heads of income. What is the next heads of income? That is income from house property. But house property income is only 85,000. So that how can you adjust 1,65,000? You can only be adjust is 85,000. So that's why I have mentioned here that is loss from textile business under section 71. It is 85,000. So that what is the note number 1? The note number 1 is that is loss from textile business, that is 1,85,000, that is 1,65,000 minus 85,000, that is 80,000 will be carried forward. That means 1,65,000, that is my residual losses, minus loss against the house property, that is 85,000, that is 80,000 will be carried forward. So that what is my gross total income? My gross total income is only from the salary income, that is the salary emoluments, that is 3,60,000. Now coming to the third scenario, that is income from non-speculative business. Income from non-speculative business, that is Mr. A following having income and losses for the previous year 23-24. This is the another type of scenario. Income from non-speculative business 4,35,700. Income from speculation business, it is 87,300. Income from fixed deposit, that is bank fixed deposit, is 1,25,200. Loss from non-speculation business is 1,02,200. Loss from speculation business is 95,200. Contribution to public provident fund is 15,000. Donation to Jela Shiksha Samiti, that is 10,000. So compute his net taxable income and tax liability. So we are supposed to hear that is the only the computation of net taxable income. So this is actually the real time scenario. That is, if you are having income from non-speculation business, if you are having income from speculation business, if you are having income from other sources, if you are having the loss from non-speculation business, if you are having loss from speculation business, and you are made, and that you have made the some sort of donation to the public provident fund, that is under section 80C under the deduction, and that is the donation to Jila Shiksha Samiti, that is 10,000, that is under section 80G. So now this is the solution. So just the let us understand that is one by one. So computation of gross total income of Mr. X for the assessment year 24-25 relating to previous year 23-24. First, income from business. So that income from business is, that is, we are having two types of business. One is the non-speculation, that means this one. One is the non-speculation business, another one is the speculation business. Just I am highlighting one by one. One is the non-speculation business, that is this one. Another one is the speculation business, that is this one, right? I am just highlighting. So that if I am having the income from non-speculation business, it is 2,35,700. This one, it is 2,35,700 minus, if you are having the brought forward losses, that is brought forward loss means, that means just I have mentioned, that is loss which may incur previous financial year, and it cannot be adjusted. I repeat this once again. I repeat, loss it may incur previous financial year, and it cannot be adjusted with the same financial year, so that it will be carried forward to the next assessment year or that next financial year. So that income from non-speculation business is 2,35,700. Loss from non-speculation business, it will be 1,02,200. So that this one, so that if you subtract this, so that you are having income from non-speculation business is 1,35,000, 1,33,500. So that this is the first case, that is income from non-speculation business minus brought forward from the non-speculation business. So that after this subtraction, we are having, that is 1,33,500. Next is the income from speculation business. This one, income from speculation business, it will be 87,300. So that it will be 87,300 minus brought forward loss from speculation business, it will be 87,300. This one, it will be 87,300. So that if you subtract it, it will be nullify the all the losses with the same heads of income, that is under section 70, that is under section 70. Next is the income from fixed deposit, that is taxable under the income from fixed deposit, that is income from other sources. It will be 1,25,200, right? So that if you go through the relevant details, that is income from fixed deposit is 1,25,200. So that if you add up or that clubbing of these five heads of income, that is income from business, that is the non-speculation business, income from speculation business, as well as the income from other sources, if you clubbing of these three heads of income, you will get, that is the gross total income of 2,58,700. So that from this you may deduct this one. So that from this you may deduct under section from this you may deduct under section 80C to 80U under the chapter 6A, that is contribution to PPF, that is 15,000, and under section 80G of the category 1, that is 100% deduction limit, that is the donation to Jila Shakkarata Samiti or the Jila Shiksha Samiti, that is 10,000, that is 15 plus 10, that is 25,000. So that if you subtract the total income, that is 2,58,700 minus 25,000, it will be 2,33,700. So that I am trying to establish these three type of example with the three different scenario. One is very simple, that is the intra-head. Another one is the intra-head. Another one is the inter-head setup. And that the another one scenario, that is I am trying to establish, that is how you can face or that how you can face to set up the losses that as per your ITR rule, that is as per your income tax relevant form. So this is just for the synopsis, that is carry forward of losses from the house property, that is a set off against the house property. Just we have mentioned that if the house property losses cannot be adjusted with the same rate or the different rates of income, it will be simply carry forward for the 8 relevant assessment year, and that the and that the carry forward of losses of the non-speculation business, that is the time frame of the 8 years under the various type of the return section. So that the carry forward loss under the capital gain, that is just a synopsis, that is short term capital loss, long term capital loss. Short term capital loss can be adjusted with the long term capital gain as well as the short term capital gain, and the long term capital loss can be adjusted with the long term capital gain. If you are not having the long term capital gain, it will be incurred, that the it will be carry forward up to the 8 assessment years. So that these are the relevant provision, or these are the relevant business. Section 73 deals with the loss in a speculation business, that is if you are having the speculation business, just I have mentioned, just we have discuss since from the beginning. There is a speculation business, that the if you are having the speculation business income, and that the if you are having the non speculative income as well as the speculation business losses, that this speculation business loss can only be set up with the speculation business income, and that if you are having the non speculative or that the speculation business losses, it will be carried forward up to 4 assessment here. So that carry forward of losses, owing and maintaining of resources, that it will be carried forward with the same heads of income. If you are having not the same heads of income, then it will be transferred to the 4 relevant assessment here. And the carry forward of unabsorbed depreciation, that there will be no time limit. First of all, it will be chargeable, or that first of all, it will be charged against the same heads of income, that is profits and gains from business and profession. I repeat this once again. I repeat that the unabsorbed depreciation, first of all, it will be charged against the same heads of income, that is the profits and gains, because these profits and gains of losses are the same heads, or the business activity, or the same business incurring income, that is the profits and gains from business and profession. If there will be no profits and gains of business and profession, then that it will be adjusted, that any heads of income except salary and the casual income. And that if you are not having salary, if you are not having the any sort of other heads of income except salary and the casual winning, so that it will be carried forward to the next assessment year. So that I repeat this once again, student, that is first of all, that is unabsorbed depreciation with the relevant provision, short-term capital gain with the relevant provision, short-term capital loss with the relevant provision. It will be utmost important in this scenario, so that only the loss or only the various type of profit that is not being accountable for the particular relevant one, it will be relevant, that how you can set up, or that how you can adjust these losses with the particular scenario. So that with this, I am supposed to end my session, and the over to you, sir. Sir, over to you.
Yes, sir. Thank you so much, sir, for your lucid explanation on write-off and carry forward of losses. It was really great session, sir. The way you have explained the theoretical part in the beginning, then calculation methods, then you have clearly explained the relevant examples of the set off and carry forward of losses. It will surely benefit the undergraduate students. And thank you once again, sir, for your
Thank you, sir.
contribution
Thank you,
continuous
sir.
contribution for students and their academic advancement. Thank you so much.
Thank you, sir. Thank you.
With this, we are ending today's session. Thank you all.
Thank you.